Welcome to the Investor's Edge, where capital meets conscience. I'm Marvin Clement, and with me today is the one and only co-host with the most, William McCoy, strategic investor and expert in all things alternative investment landscape. Will, great to have you, brother.
You too, brother. You are one of the most intelligent investors I've ever met. Love doing this podcast with you, Marvin. Well, always good to be with you, Marvin. Today's topic hits at the intersection of technology and power and opportunity. Stacey Abrams recently sounded alarm about how AI can be misused as a tool for authoritative control, right? And as
hmm
investors, how we need to unpack that and what it means for markets, ethics, and also long-term value creation.
That's true. That's true. Exactly. With any new technology, there's going to be impact and ripples in society. So it's also going to shape the investment landscape. So, in the next 15 minutes, hopefully what we can do is we can explore how this controversial and conversation about AI connects to crowdfunding and alternative assets. And then, we can also talk about how smart investors invest responsibility, the opportunity to diversify into founders for building transparency, equity, and resilience. So, got a lot of things to unpack. So let's get right into it and talk about the AI shift and the market risk. Ooh. So, as Will alluded to, Abrams pointed out that AI, when unchecked, can amplify bias, empower surveillance, and centralize control. Those are not really good things. So, modern algorithms dreams, but for investors, that's a signal because whenever power concentrates, markets become fragile, and when fragility raises, opportunity emerges elsewhere. So, the key thing is, are you aware of when the fragility rises?
And also, that is the key, right? Like every time something, technology threatens centralization, whether it's industrial and a monopoly, social media dominance, and we see that, right? Like, give you an example. A lot of black founders are coming online and talking about how they're being censored when it comes to things, and they're not seen, they're not being seen. And there's a specific company out there right now. There's a social media marketplace up and coming called Fanbase, and it was built by a black founder because of that reason, right? They one weren't getting paid what they should have been, and then two, their voices are really being stifled on these social media platforms. Well, this is being funded by what we call an alternative market. He's placed his company on a broker dealer platform that allows people to crowdfund and also impact his startup, decentralize how people are able to invest, right, and then give that founder diversity uh, that people are looking for. So it's risk management because it is being regulated by an SEC crowdfunding platform, but it also gives diverse founders the opportunity to be able to put their ideas out there that's going to be impactful for their audience.
Yeah, Will, yeah, like you discussed, risk management's a big thing. You're not just investing for altruism, which is fine to do. That's good. Investing isn't just about doing good, but you have to hedge against a system that could become too concentrated, too opaque, too brittle. And these are the things that are the opposite of agility. So the smarter your diversification, especially across founders with different lenses and live experience, then the smarter your diversification, the stronger your long-term resilience is going to be.
Absolutely, that is you absolutely hit it on the head, Marvin, with that. Right, well said. And that brings us to the real investor takeaway: markets, rewards, inclusion, transparency, government over time. Those are the traits that compound trust and returns, and those are the things that we're going to be investing here, talking about here in this podcast episode of ReturnUs. So,
Thanks,
Marvin,
Will.
tell me about why diversity and ethics should be at the core of your investment matrix.
That's a great question. So, when AI is weaponized, it often starts with bias, which begins with a lack of representation. We've talked about this a little bit earlier, right? We don't need to beat that drum, but we understand that a lot of things begin with the lack of representation. So when you invest and you invest in diverse founders, you're not just investing in fairness. What you're doing is you're investing in a better data broker idea, you invest broader markets, and you're more balanced decision making all around. So it always comes back to that human experience about ethics. So you can't really beat it. Can't get around it.
And to back that up, Marvin, that's a good point. Like historically, the data shows this, right? We've seen time and time again, even though people try to dispute Crunchbase and other places, saying that diverse teams outperform homogenous teams when it comes to ROI and also innovation speed. And it just makes sense. Our ecosystem, the things that we love, are here because of diversity, not because they all look the same. They're
Yeah.
able to adapt and survive and thrive. But that same thing translates into business. And so when we look at these market gaps and we look at why there are wider consumer bases on certain sides or whatever it may be, the alpha is hidden in the empathy. Your ability to be able to say, hey, look, I empathize with this investor is going to help, or I empathize with this founder, is going to help you say, okay, well, I get it. I get their idea. Again, I always go back to that most recent article from Crunchbase that has all the numbers that said black founders get less than 1% of the funding. Well, some of that is implicit bias, right? These VC funds are mostly homogenous, mostly white males, mostly looking alike. And so when they see black founders, a lot of times they can't empathize with the things that they may be offering from an impact standpoint. It's just what it is. But
Hmm.
you as an investor, when you're looking at investments, you may be able to hear and empathize with that investor, that founder, to help them see or to help understand exactly how that product that they're producing is going to be an impact to not just you, but a lot of people who look like you.
100%. And that's kind of why personally, and I know I'm speaking for you as well, Will. So we like crowdfunding platforms so much because as Will outlined, there's just traditional venture pipelines and barriers. You got geography, network, pedigree, implied bias, so on and so on. But you know, and not perfectly, but we know crowdfunding does break down a lot of these barriers. It allows investors to access high potential, undercapitalized founders who might otherwise be invisible to the traditional VCs. They're just not the popular kids on the block. So, you know, I'm always about leveraging the field, and that's what we believe crowdfunding model does, and it does it well.
Yeah, I mean, that's the bridge, right? So by combining ethical awareness and diversification, crowdfunding and alternative assets, and founder diversity, you can mitigate your moral risk, but also amplify your financial opportunity. It's all about diversity when it comes to your investment. You want to have some here, some there, some there. Just
Hmm.
this week, if you were in Bitcoin, I mean, you took a huge hit, right, when you came to Bitcoin. A lot of people
Yeah,
were. But if
yeah,
you were diversified, you could say, okay, well, while that's going on, some of the other things are going up, right? And even when it came to alternative investments, now you can do the same thing through crowdfunding. You can invest in these startups who are up and coming, who are trying to fix gaps, huge gaps that big companies have. They're trying to figure out, but they're just too big and large. So you can go ahead and get inside of them early and then fit that diversity that you're trying to look for in both your portfolio, but then also the type of founders that you're investing in.
man, that's such a great point. And another underrated point that we don't discuss a lot is that while you're doing your research and looking into these different startups and founders, it almost gives you a trend analysis of the next decade. It gives you insight into the big wave things that are coming because you start to see the trends. And where there's purpose and where there's planning, that's where you make profit. And that's how we're going to start to talk about our next topic as we move into the investor playbook. Because again, everything is good, but like we said, if you don't have a purpose or a plan, things fall by the wayside. So with that being said, Will, let's break it down. How should investors approach their portfolios now that AI, ethics, and inclusion are all converging forces?
So, three key principles that investors want to keep in mind. One, they want to allocate to ethical tech, right? Companies that are
Hmm.
designed for transparency, security, inclusion will be the future, right? We know one of the biggest markets right now in the world is Africa. It
Yeah.
is trillions of dollars and has the fastest growing both economy, but and also the youth population in the world right now. Well, that's a way that you can allocate to ethical tech, right? Diversify across founders. Look for founders who look different than what you are typically seeing as far as founders. These founders will have different perspectives. So that may be a woman, that may be an immigrant, that may be a black male, that may be whatever, right? All these people are going to have information according to their group. And a lot of times what founders will say is that, hey, look, I'm looking for someone who can start small within a niche and then grow that niche, right? Well,
Hmm.
these diverse founders are well equipped to grow that niche because a lot of times they're targeting and trying to impact a group of people who have been typically ignored, which is also a great opportunity. And then engage via crowdfunding and alternative assets. Again, there are plenty of platforms out there. We hope to have an upcoming one as well. But these platforms will allow you to invest directly and safely into these particular startups. Now, there's always going to be risk, and you have to hedge your risk, and there's
Yep.
always issues with liquidity and things when it comes to any type of investment. But these early stage innovations will allow you to be able to put capital in early and then catch up to what some of these other companies may be doing in the future.
Great, man. I appreciate that outline, Will. I think that's going to be very beneficial for a lot of people. Another question, though. What red flags should investors avoid in this new landscape? There's a lot of things changing. What are the top red flags that come to your mind in this new AI landscape, especially with crowdfunding?
Yeah, it used to be the thing where everybody was using like ventures as like property, so they would sell it, right? We can sell data, whatever it may be. That's changing from selling data to trust, right? Avoiding leadership teams that lack governance or structure. So what that means in real time is that you should be able to, as an investor, see what the structure is very clearly, who is running what it may be, even things when it comes to like written supervisory procedures and policies. You want to make sure that that governance is there and it's well written and well organized, and then also avoid platforms that articulate how to manage how that can't articulate how they manage compliance risks or social impact. Those are early signs of future volatility with that company, because if you don't get it right in the beginning, if you don't have those building blocks in the beginning, it's hard to put them back in place once the company's running, right? Allowing you
Yeah.
to get your money and everything else. So you want to start with that with the beginning in mind. What do you think, Mark?
Yeah, I was. That's a good point. I think that's a great gem out there for everybody listening. So, just to be clear, and this for the benefit of everybody at home. So, would you agree? So, investors need to start seeing social alignment and governance as part of their risk analysis and not just as a side note. So, really just focus. Is that is that what you're saying?
Yeah, I mean, absolutely. We're moving from ESG to now EDG, ethics, diversity, and governance. Governance needs to be key when it comes to these companies. Who are the founders? How are they put in place? What are they doing? Not just, ragtag team put together, but some team that's well grounded around the policies, right?
Yeah.
And then, you want to audit your portfolio, right? You want to make sure that you're looking for investors who are concentrating obviously on AI, right? But obviously with AI with some type of purpose in mind, not just we got AI, right? But what does that AI
Yeah.
do? How is it measurable? How is it used to increase efficiency? Like we talked about in the former podcast, those type of things.
Love it. Love it. So, we've come to one of my favorite parts of this segment because this is when we leave you all back home with an action plan. All right, so investors, here's your three-part action plan and your takeaway from today's episodes. Will, take us there, please.
All right, so step one, audit your portfolio, look for current allocations, how many of them are concentrated in companies or sectors that could be disrupted by unethical AI or centralized power. Shift 10 to 15% into decentralized and inclusive innovations. You're up next, Will. Marvin.
Step two, back diverse founders directly. So, platforms like crowdfunding portals are gold mines for discovering talented and overlooked by traditional capital, right? It's great at finding those who have been overlooked. So, these are your asymmetric bets, high potential, often undervalued, and driven by mission. Look out for those folks. Look out for the diamonds in the rough, all right?
Step three, invest in ecosystem resilience. Think infrastructure, fintech, governance tech, platforms, support compliance, access, data rights. Those are the things that are going to be the backbone of the next ethical economy.
Brilliant, brilliant. Well said. And okay, and remember, and we always say this: this isn't charity. This is strategic diversification. So investing in diversity and inclusion is investing in better risk-adjusted returns. But it's not. I'm not saying charity. All right. So still come at it with an investor's mindset.
So let's wrap it up, Marvin. The best hedge against concentrated power and diversified investment is in founders and in ideas that have diversity in markets and diversity in people and founders.
100%. So as Stacey Abram, as we started at the top of the show, warned about, AI isn't just a political conversation; it's a financial roadmap, and it tells us where the risks and opportunities are heading. So just make sure you're aware, so that way you can make your best action calls.
And all to all the investors out there, if you have companies who are getting ready to raise money, please have them contact us. We have opportunities for them both here in the U.S., but then also on the continent of Africa. We would love to hear them pitch. We have a weekly pitch competition, so please keep us in mind each week. Please continue to tune in, and we really appreciate you. And until next time, invest with insight, diversify with purpose, and always think long term.
It's been another edition of Return Us. You all stay safe, invest well, and be blessed. Peace.